So today we're going to talk about a stock that I cannot stop buying. I've been buying this stock very aggressively. I think I've bought this around about 4 times in the last 2 weeks, maybe even more than that. And it's quite rare for me to do that. And what's happened here is we've had a very good combination where the stock was already pretty good value. The stock then continued to drop lower, and yet the fundamentals were getting even better. And there was two new news stories that have come out recently that have given me even more confidence to go buy this stock, and yet the stock continues to go lower. And it's quite rare that this happens, and it's quite rare it happens on a stock that is a growth stock, but also a value stock and a dividend stock. It's a stock that has the really good combination of all three factors, and it's very rare to find a stock that kind of ticks all three boxes of, like, it gives you the growth, it gives you the dividend, and yeah, it's really good. I've talked about it quite a few times already in the last couple of weeks, but I'm going to make a video on about today and talk about the new news that's come out, why I'm really excited about this opportunity, and then also I'll show you my updated numbers because the fundamentals have probably got a little bit better. But yeah, the share price has got lower, and the upside has even increased even more. So I'm going to share that all with you today. And what I'd say is, certainly in my opinion, is that right now I would go to as far as saying that this is probably the best opportunity that I'm seeing in the market right now. If you asked me a couple of weeks ago, I probably would have said the likes of AMD, for example. A couple of weeks before that, it might have been Google. A couple of weeks before that, it might have been Zote phones. And when people say to me, okay, what is probably the one that you're seeing as like the best opportunity right now? This is certainly the one that I'm buying most aggressive right now. So I would say it's this one. So yeah, hope it's useful. So what is the stock? Hollywood Bowl. Hollywood Bowl is, in my opinion, a great company. Like I said, great growth, value, dividend, great valuation. And it's a stock that I have owned for many years. I've owned this stock for over 5 years now. And since my first couple of buys in this stock, since the kind of CV days, I've got some shares in this stock that are up a significant amount, up 88%. However, I just continue over the last 5 years. All I've done is continue to buy more of this stock, and whenever this stock has a dip, I just add in because I want to make sure I'm watering the flowers and getting rid of the weeds, not watering the weeds and getting rid of the flowers. And that in my portfolio, I regard Hollywood Bowl as being one of the flowers. I would say it's one of the best stocks I have in my portfolio, and I just continue to buy. I've got some shares that are up 88% since the CV days, but overall, I think my position is only up around about 10%. And the reason why is just I keep buying more and more and more, and whenever we have these dips, I just keep averaging up on it because I still see the upside getting bigger and bigger on this company. So it's 14 times earnings, but we're going to look at the forward earnings, which is probably more important because they are having a bit of a dip in the profitability at the moment, and we'll take a look at that. Now, first of all, 5% dividend yield. So this is what I really like, and I'm getting a bit older as an investor, not too old, but a little bit older as an investor. I'm appreciating dividends certainly a little bit, and there's something really nice about getting a 5% dividend yield. When you do get those 5% dividend yields come into your account, it is quite a nice feeling. It's a chunky feeling, and what we'll probably see in a few months, maybe years' time, is that we probably will see interest rate cuts come down, and at the moment, a lot of people getting those 5% interest rates, or maybe slightly lower in the bank account. But when those interest rates start coming down, there's going to be a lot of people flying back into these dividend stocks, and dividend stocks will seem a lot more attractive when the interest rates that you're getting on your accounts are certainly going a lot lower. And that dividend also has potential to hike up massively in the next few years. There's a reason why, if you look at the likes of Warren Buffett, I believe Warren Buffett actually achieves more dividends and payments from the shares he owns than actually what the CEO of from Coca-Cola than what the CEO of Coca-Cola gets paid, which is just an absolutely mind-blowing fact when you look at that point of view. Like I said, historically, this has been this is why I like the company. It's historically been delivering so well. If we do go on the past performance, and if you look at the last 5 years, revenue has gone from 131 million, gone all the way up to 240 million. If you look at the profit, it's gone from 21 million up to 28 million. That's with a little bit of dip in profitability at the moment. So historically, yeah, financially been absolutely amazing. Now, like I said, we look at 2026 numbers. I'm not really too bothered about where the company is because I'm investing for 2 to 5 years. I'm more bothered about where the financials are going to be. And if we start looking at 2026 numbers, which is what I'm starting to do because we're only realistically a year away from that point of view now, the company's actually trading at 10 times forward earnings, which, Hollywood Bowl has historically traded probably around about 18 times earnings. If we look at before the CV times, and even only a year ago in 2024, it was about 18 times earnings. So it's normally been a lot higher than this, nearly double the valuation to what it is on the forward P. And I always argue the case that, in my opinion, that's even cheap for Hollywood Ball, because when you get a company that's growing at the rates they're doing, and by the way, this has an absolute, immaculate balance sheet. Just have a quick look at this balance sheet. So if you look here at the balance sheet, where is it at? Is it going to load for me? So yeah, they've got no debt on the balance sheet when previously they did. They've paid all that off there, and any cash they generate just goes straight into the bottom line. That cash allows them to go increase the dividend or do share buybacks, which we're actually going to talk about in a little bit. And it just goes all to shareholders. And Hollywood Ball have quite a kind way of returning a lot of capital to shareholders, which is great. And for a company like this, in my opinion, this is normally a company that forget 18 times earnings. This is like a premium company. That this is probably should at least be trading at like the market average valuation, like 20 times earnings. So yeah, it's historically low valued, and I think it should be even more than this. But even if we just go off 18 times earnings, yeah, pretty good value overall. So yeah, really big fan of Hollywood Ball. What they're doing at the moment is they're expanding the UK centres. So they've gone, they're trying to get from 75 centres to 95 centres. That is kind of getting a bit more mature now, and Hollywood Ball have kind of realised that. There's still good growth there, and the new venue should help growth continue and like flight continue, but they have also expanded into Canada. Canada is their big growth driver going forward, and at the moment they've currently got 15 centres, and they plan to get to 35 by 2035. And that's going to be the big growth driver for them, because when you do look at the likes of the Canada total revenue, that was actually up 40%, which is, that's the clear driver for them that they've expanded to, which I think was in 2022. But the UK is still growing okay, but that Canada is just going to top up that growth there, where we have like high single digit growth, which is absolutely amazing. High single digit growth on a company that also is paying you a 5% dividend yield looks really good. Now, obviously, the share price, not so good. You do look at the share price, it kind of peaked around May 2024, and the share price has fallen about 28%. That is the largest dip that Hollywood Ball has had in the last 5 years, apart from the 2022 situation when we had the Russia-Ukraine situation. Obviously, we had inflation going sky high. So this is one of the most major drops that we've had in the last 5 years in Hollywood Ball. And I guess you look at it and you go, okay, what is causing that stock to drop that much? Where it's down, and it only continues to drop at the moment as well. Well, you know what? I thought, let's go to Gemini. Let's go on Google Gemini and ask them what can it pull up for the reasons. So the first thing is impact of good weather. So there's been good weather at the moment. I'm sure if you're in the UK, you've seen it. It's a little bit worrying, because it feels like we might have had our summer now, and when it gets to August, we might have peaked. But yeah, it's been a good batch of weather through April, May, into June, and even into July so far. Now the thing is when you're a bowling alley, no one wants to go inside into bowling alleys when it's sunny. People want to go outside, go to cafes, garden centres. People don't want to go inside. You go inside when it's a bit cold, miserable, raining, and that's why we saw, I think it was a year ago, Hollywood Ball had a good year last year because we had a pretty crap summer. And because we had a pretty crap summer, people were like, well, what we're going to do today? Because we can't go outside anywhere because it's, the weather's too bad. And what they did is they went to places like Hollywood Ball. So Hollywood Ball had a good year last year. This year, not so good. So that's certainly a big reason that's kind of impacting the moment. And what will happen is this will level out. And I think there's also a couple of things as well with that, is that like Easter weekend's fallen a little bit different this year, for example. And I think it's also a leap year as well last year. So they also talked about lower profit despite higher revenue, which is never a good sign. Now, the thing is that we know that when we look at the administrative expenses, and we can link this up with the share price, we know a lot of companies that are employing a lot of people have had impacts basically since the back end of 2024. We've seen a new government come into the UK, and obviously we know they basically tax anything that's breathing, basically. So we've seen the likes of the minimum wages go up extortionate, 3 times inflation. We've seen the likes of the NI contributions go up significantly. So that means costs have gone up a little bit more this year because of those impacts. Now, hopefully, we don't see a big surge of taxes like that and costs happen again next year. So once these are in place, then the big increases are going to level out a little bit, hopefully. So hopefully that kind of balances out going forward, and we don't see that happen again. Now, you never know with the current government that we do have in place, but those are hopefully something that doesn't continue as much going forward. So yeah, they've had to eat a bit of higher costs at the moment, but obviously what will happen eventually is that you would hope more venues that Hollywood Bowl open up, they'll level that out with efficiencies, and also there'll be the increases in prices to kind of offset that going forward. And that's clear actually when you do look at Hollywood Bowl's profit margins, because Hollywood Bowl's profit margins have dropped from where they historically have been, where it's like 15-16% profit margins, down to about 11% profit margins right now. So hopefully they will drag that back up to historically where they've kind of been, really. The other reasons is a competitive landscape. Now there is a lot of competition out there, but I would say Hollywood Bowl is different because most of their competition goes into like city centres, where Hollywood Bowl goes to more leisure centres. So I wouldn't worry about that too much. I think there's no certain big competition change from where we were 3-4 years ago to where we are right now. And even analysts, it's actually picked up here that analysts have said that the due to the weather impacts, but even with the weather impacts, once you take that out and it will level out, the underlying strength is still very much there with Hollywood Bowl. And I think that is totally the correct thing. I think that a lot of these are one-time impacts and come back in 12 months and you'll be thinking, that was a bit of an opportunity in Hollywood Bowl, and I think they'll move on from it. Now, the reason why I've gone and bought more aggressively recently in Hollywood Bowl is because in the last month the stock has, once again continued to fall. It had a little bit of a bounce up yesterday, but apart from that bounce, we saw it drop another 10% in the last month. And like I said, for me, I've been more buying aggressively in the last few weeks, more than ever. And the reason why is, like, first of all, I've seen no deterioration to the business model just yet, and yet the stock is cheaper. I like that. If I can buy a stock for even cheaper prices and there's no change there, I will go buy the stock. But fundamentally, I said to you that the fundamentals have also got a little bit stronger. And the reason why is because there's two things that have happened, and both of these things happened yesterday, and this is kind of why I'm making the video today, actually, is if we do go on the RNSs. So first of all, share buyback program. If we click here, Hollywood Bowl have just completed a share buyback program, and then they announced another one. So they did another 5 million share buyback. It's nothing huge, but it's good to see. They can't go too much because obviously, they've only got a 29 million cash pile, so they can't do too crazy of a share buyback. But to use that cash to buy the stock when it's very cheap is great. That's a great move, and even if it's not a huge amount, it shows you that, first of all, great capital management, but also that the management team are kind of saying to you guys, look, we weren't planning on doing this, but shares are that cheap. We've got to put some money to buy some shares up at these levels because it's just way too cheap. And that's great. And that's always the same thing with the Hollywood Bowl management team. I always feel like, the management team, is it Stephen Burns? He's been here for, I think, 10 years now, maybe even longer. I'm just going to have a quick look. So that wasn't a bad guess. 11 and a half years. Like, he's seen this business go to major success with what he's been doing here. And once again, it just shows you, like, the management team have made great decision after great decision about expansion locations, the arcades, the bar area, revamping them, moving into the Canada expansion, the capital allocation, managing through the CV times. And right now, while the share price is having a dip, great allocation to the capital to be buying up shares, which is great. And then the second thing came through, so that was already positive, but insider purchase. When insiders are buying shares, there's only one reason why insiders buy shares, and it's because they believe the share price is going to go up. And if you want a bit more of an indication from the management team, like, this is a bit cheap, they're even buying shares themselves. So we saw Stephen Burns, once again, the CEO of the company, he bought another chunk of shares. So he bought, where's it at? So £2.39, bought about 12,000 shares. So what's that, about 30k-ish? So yeah, another 30k of shares, which is great. And if we do look at let's have a quick look here. So what makes it also quite impressive is that he also bought he bought another 40k worth of shares in December time. So that's on top of what he only bought about 6 months ago, which is, once again, another confidence boost. He's already bought some shares and he went, you know what, I'm going to buy even more shares. Really good confidence boost. And that follows on from, a good chunk of other insiders buying shares. So for example, £2.50. You had the chairman of the board buying on the 11th of March, for example. Another member of the board buying as well. Another member of the board buying. So yeah, this is what you want to see. Clearly, if management are trying to hint here, like, we believe the stock has probably gone down way too much here because they're buying themselves, and then obviously to put the capital in there to buy more shares when they weren't really planning on doing it after already another 10 million buyback. Yeah, it's just a great confidence boost, and that's what's giving me confidence as well to go a little bit more aggressive at the moment as well, is because I'm seeing those kind of signs there that, hey, they're trying to signal something to us. Now, on the number point of view, because the stock is going cheaper, yet the financials still look pretty stable, the upside is still getting more attractive. So revenue growth of 4, 8, and if they get to 10% growth here, profit margins of 11, 13 and 15%. Don't forget, like I showed you guys, historically this company has been a company that did, was it 17% profit margins? Sorry, 16%. Yeah, 16, 17% profit margins. So yeah, not too ambitious there at all. I'm showing not much, profit margin expansion to what they've normally been at. 18 times earnings, that's what they've normally traded at. I think it could be higher, but we'll leave it at that. So on the low side, yeah, even on, if the profit margins stay shrunk down, even if they only grow 4%, which is a slowdown from where they're at right now, 41% upside. And let's not forget, you get that dividend yield, which was a 5% dividend. So let's times that by 5 years time, that's 25% return. Add that on top, you're up to 75% return on the low side. Mid side, you're nearly getting that 100% upside, which is what I like to see. Add a 25% dividend on top, you're getting all the way nearly up to 120% return there. And on the high side, 140%, add another 25% on top, for the dividend, and you're up to 165% return. So these numbers are showing massively where I'd like to see. Now, let's not forget, let's say this company does, on the mid side, let's say they do get up to that 15% profit margin. That's a nice 123% upside, 25% top. You're up to 150% return. Let's say the market does finally hold the ball to where it should be, which in my opinion is a 20 times earnings. You're up to nearly 150%. Add your dividend on top, 175% upside. So yeah, this is very much in the realms of like where I really like a business. My low numbers are coming up as very good returns. Even having not ambitious numbers, they're coming up as 100% returns. And then if they do really hit the really good numbers where the revenue growth is growing strong again, the profit margins go back to what they historically do, the metric expansion comes in, we're even getting more than 100% upside, we're getting to the 200% upside. I really like those opportunities, because it says to me is that even if things go wrong, I still do okay here, and I still collect that lovely dividend. But if they do go to where I think they could go, I'm getting that 100% return, and it's not ambitious. It's quite achievable. But even if they really execute, we're not only talking 100% return, we're getting towards 150, 200% return. And those are the opportunities that I'm like, sign me up. I really like those opportunities. And then, like I said, I'm getting, why I'm also buying so heavy at the moment is that I'm getting those conviction signs as well. It's not just kind of me like, hey, I think this is good, I like this. But what gives me more confidence is when I'm seeing those kind of like little nuggets where it's like, more share, but we think it's a little bit undervalued, so we are increasing our share repurchases. The signs of like insiders are going a little bit more aggressive on it. It looks good. So yeah, I am buying this one, and it's a stock that I'm buying the most at the moment anyway. So yeah, hope you enjoyed the little update on that one anyway, and thanks for watching, and see you in a bit.